Welcome to the daily update, where I'll go over the action in the market for Tuesday, February 4th, and we'll see how things look for Wednesday, February 5th. Had a nice little bounce. We're kind of back to where we were last Friday, and we're seeing a little bit of improvement with some of our indicators. We're still seeing some weakness with other indicators as the market continues not to trend, both in the short and intermediate term. We're just chopping around right now. Let's go back and talk about what happened. Right at the open, we did have a higher open. We were able to get back above 6,000 and we were able to get a little bit above R1 at 6,038. Then we retraced a little bit, not a reversal, but just fell back. And then we were able to climb back above R1 and we closed slightly above R1 for the day. We were up 0.72% on above average volume. And when you measure things using moving averages, we're still positive in the short, intermediate, and long term. Our short term indicators are just kind of bouncing around, not really showing any conviction right now. We're seeing a little bit of improvement, but also some weakness in some of our intermediate term indicators. And a lot of this has to do with, okay, all the executive orders and the confirmation process and the tariff news going back and forth. That's really making the market kind of confused right now as to how things are going to go. Google did report their earnings after the close, and they're spending more on R&D, and that's pushing things down about 15%. So that's going to drag the futures down. We'll see if that carries over into Wednesday's session. As far as the tariffs, Canada was granted a 30-day reprieve. And then China, they're like, okay, America, you're going to put tariffs on us. We're going to put tariffs on you. It seems more symbolic than anything. The hope is that at least the two sides are talking and maybe something can be worked out there because Trump is a negotiator and that's what he's trying to do. On a short-term basis, we still only have one indicator that's extreme positive, and that's the slope oscillator, but it's going down now and it's crossing below its moving average. The mass index, the further we get away from the when the criteria was actually triggered, the more irrelevant it becomes. But it's still there. And as the market's meandering around, not really showing a lot of conviction right now, I'm keeping this on the list. No real changes to the scenario. Now, this is a big employment data week. We'll be seeing, is that going to feed into the idea that the Fed could come in and start cutting rates again, or pause for longer, or if the reports come in pretty strong, then they may have to actually come in and raise rates. That's what the market's mulling around right now. The dollar was down and interest rates were also down. We're still dealing with that 4.51% level with the 10-year yield. If we can get under that, that would really help things a lot. Where after Monday, we were at 4.54%. We are still ticking down. Even though we were up with the S&P, sentiment is still going down. Now, this could actually work in the market's favor if a lot of people are really nervous about the market. It likes to climb a wall of worry. So that might help things. But anyway, we're back into the negative area at 39, where we had been neutral at 44. And we're still not trending. We are negative. The red line is still above the green line with the ADX. We're below 20. We're below the moving average. And even though we had the up day, there wasn't really a lot of strength under the surface. And I'll go through the charts to show you that. So I'm keeping the bias right now at mixed, even though we were up pretty strong on a percentage basis. And I'm also keeping the momentum at mixed because the market is just chopping around. So the economic reports that came out, factory orders were down 0.9%, much more than the 0.3% they had expected. That's showing some weakness. Excuse me. Last time it was down 0.8%. And part of the employment data that's coming out includes the JOLTS job openings. It decreased. And so the market's like, well, maybe we're seeing some weakness in employment. But these different employment reports that come out during the week, they're by different entities. And sometimes we get really varying reports. One will come in showing weakness, another one will come in showing strength. And the real focus will be the one that we get on Friday. That's the one that most of the market pays attention to. But the job openings were at 7.6 million. Last time they were at 8.1 million. And we have been seeing a decline. We were in the 10, 11 million job openings just a few months ago. And this has just been gradually getting lower and lower. So here is a chart. The factory orders year over year, just slightly below zero here, just kind of chopping sideways. Durable goods year over year, also below zero, but showing a little bit of an improvement. Non-durable goods, things that don't last very long, apparently they're a little more positive right now. We're above zero year over year there. Non-defense capital goods, you take out aircraft, this is where we saw a little bit more strength, a little bit of an improvement and above zero year over year. Then the job openings, where back here a year or so ago, I said a few months ago, it was actually a year or so, we were seeing really strong numbers. And now overall, they're still strong, but we are seeing them kind of dropping off. We see little blips up from here at different places along the chart. Looking at our weekly version of the overbought, oversold composite, we're coming in at 73 now. Usually it's when we get above 80, and then when we get above 90, that's when we're really overbought. We have been dropping back as the market has been chopping around lately. Then we look at the ISM manufacturing. That's the purple, excuse me, the gold line here, where we're seeing a real improvement, and that's showing economic strength. And for the first time in quite a while, we're above 50 with this reading. That shows expansion in the economy. And then we combine that with, just to get a relative look here, with the purple line, which is the S&P 500. And you can see there's a pretty strong correlation between the two. So if manufacturing is improving, that should give some support to the S&P. Consolidated equity positioning still pretty high, still really into stocks right now. Equity, that's stocks, and starting to go back up currently in this latest reading with this chart. And then the mega cap stocks and tech, this is still where most of the money is, even though it's been coming down lately. We're starting to see a bit of an improvement here. And the probability of a recession seems to really be dropping down according to this chart. Again, the debate goes back and forth. Yes, we're going to. No, we're not. And there are people that I listen to that I kind of respect what they say. Some of them are saying, yes, we're going to be in a recession. Some are saying no. There's other people that I really don't respect, but I kind of listen to them just because they sometimes offer a unique perspective on things, and they're divided as well. And of course, they're dogmatic about what they say, whether I respect them or not. I look at the data and we just try to evaluate things with what we're given to see, okay, what does it look like? But right now, we're really seeing this drop off with the probability of a recession. And then the risk appetite indicator coming down a little bit, but still folks are willing to jump in and assume more risk, which usually means buying stocks. And then the flows that we're seeing into the tech sector, a lot of money going in right now. And this is the darling area, and it's been the darling area and will probably continue to be the darling area. But we're just seeing a lot of money going in right now. And then this is kind of a interesting chart here. I usually go over this in the weekend video in the intermarket analysis. This looks at earnings and then compares it with price, and we get a PE ratio from that. And you can just see where the different indexes are, not only in the US, here's the S&P, that's the one we focus on, but then compared to the NASDAQ 100, Europe, Japan, small caps, China, and so forth, just to get a little bit of a perspective. And most of the expected growth is still in the NASDAQ 100. Those are the real growth stocks. Those are the mega cap stocks. Some interesting charts here. The S&P growth investment running above its global peers. That just means there's more money going in. This is CapEx, and then also research and development. A lot of money going in to, and that's a healthy sign when they're reinvesting a lot of money for future technology and improvements compared to what's happening globally right now. And then the return on growth investment. This is what they're looking at with the 10-year median over here. And then this is the US is the dark blue, and then the rest of the world is in lighter blue. And then what is the looking back here, also showing that most of the returns that we're seeing have come from the US as the US stocks are outperforming the rest of the world currently. Then trailing the broader market when it comes to capital expenditures and R&D, those companies that spend a lot of money, they tend to not perform as well. And if you think about it, there's some logic there. Instead of those profits going to the shareholders or it it's being used to plow back into the company, and sometimes those stocks tend to underperform where you could also take that in a positive way. It's like, great. They believe in the future. They believe in technology. They're uncovering new things. They're looking for improvements. I like that kind of a company. So, but they do tend to underperform. Then this is put out by Edward Ardeni. It shows capital spending plans, regional businesses, CEOs, small businesses, and they're all looking more optimistic as they're planning on spending more. And that's good for the economy. And then the corporate investment, you can see this is the Magnificent Seven. That's the orange line here and how they're increasing R&D in their company. Well, look, it's pairing up with the US government. My goodness. Now, there's going to be some changes if this whole Doge thing and a lot of the changes that are at least promised actually come through to the bottom line. But the US government spends money like crazy, and to have it even paired up with the Magnificent Seven is kind of interesting. All right, then US tariff threats, they go global. Who is the most at risk if there is a tariff imposed on that particular country? Vietnam is the most vulnerable, where you have China, the EU, they're a little less vulnerable right now. This is a ratio of countries' exports to US as a percent of the country's GDP to US. This is pretty convoluted up here. The takeaway I got here is just there are some companies that would be more vulnerable right now if tariffs were actually placed on them. And then job openings and labor turnover survey. This kind of goes in with the JOLTS job openings. That's JOLTS here. And we're seeing a decrease here, but more of a leveling off when you break this out in the different areas. So here's the intraday chart. We're still looking pretty good after we go after the open on Monday. We've been showing an improvement here, and the intraday action is looking better. It's not falling apart, but we gapped lower, and we've been trying to improve since. So that is positive. Then on Tuesday, we did get above the 6,000 level, got up to R1, fell back a little bit, got back above R1, closed a little bit above R1. And looking a little better here with the intraday chart, where we were showing an improvement, and then a lot of that came as we got closer to the open, and then that's we saw most of the gains in the cash session itself. Now the drop off that we're seeing with Google right now, it's not really being picked up here by the SPY in the initial overnight session. And we're seeing an improvement here intraday, growth versus value. We hit that bottom here in about the 28th of January, and we have been going up, even though the market's been going sideways. And this is growth outperforming value, which could be positive. We're also seeing the blue line above the red line. Growth is outperforming value here. That's still positive. End of day growth had a good day. It was up 1.12%, where value was up, but a lot less, 0.27%. But it underperformed with the mid caps and also slightly underperformed with the small caps. So it was large cap growth that really had a good day on Tuesday. So we're coming down a little bit, but still looking strong when we look at small cap growth to value. Mid cap growth to value really showed a nice little improvement here, even though the index has really been going nowhere. And seeing a bit of an improvement here with S&P growth to value as well. And overall, this has been pretty strong lately. Seeing a bit of an improvement, but we're still inside the rainbow when we look at the growth versus value ETF. Saw a nice little bounce here with the discretionary to staples, and this is more positive for the market as well. Large cap growth was able to get back above its 50-day moving average, where it was lost after Monday. But we're still not trending, and the red line is still on top, even though it's coming down. The green line's trying to go back up, but the red line is on top, so we default to negative, and the ADX just continues to fall, which means we're not trending. And seeing that pretty much the same picture here in the short term as well, with the ADX continuing to drop. This is the lowest reading we've had for the ADX in quite a while. But volume was still above average, even though it pulled back slightly there. Sentiment came down with the up day. We're still under 20. That's the kind of takeaway from this right now. We're seeing an elevated VIX overall, and the momentum is going up, as I'll show you here in a moment. But when we get above 20, that's where things turn really negative. We did decline a little bit with the update, both here with the line chart and the bar chart. So coming down here with the VIX of the VIX down to the moving averages, both with the bar chart and line chart. But the momentum now has switched to up, and that's more negative. So we'll be watching the momentum here, and if we get above 20 through more declines in the S&P, that could turn things more negative. Skew index coming down, but still in this red area. It's just been showing this for quite a while now. We declined a little bit with this fear gauge and we went up with the other fear gauge. So we're seeing a bit of a contradiction there. And we declined with the equity put call daily chart. And we're still going down with the 5-day chart, which is positive. And here's a longer term look at that because we're into an extreme area now where sometimes this means a bottoming process with this ratio, which could be a topping process for the S&P. But we're now going back up with our 10-day. So we're seeing some contradiction there. And we did see a bit of a pickup here with volatility risk premium. It's going up. We're still in the band here. We really pay attention to this when it's below or above this band that you see, but we did see an increase on an up day. So there's some fear that's being perceived going out to the next 30 days. The advanced decline line for having a pretty solid day as far as price didn't really improve based on price. Ticked up a little bit here based on volume. Longer term, though, we're still positive since we're above advancing moving averages. And we're still declining with our advancers minus decliners over a 10-day period. You would think on an up day like we saw, this would turn and go back up. No, it's actually showing a little bit more weakness internally in the S&P. And we're rolling over with the new highs, new lows with the 5-day and the 10-day, even though we saw more new highs than lows. We're contracting with the new highs and seeing a bit of an expansion with the new lows. And this had been turning positive. We got above this green line. Now we're starting to drop back. This is a 10-day average of the highs and lows for the S&P. This is showing a little bit longer term weakness. And declining still, but positive with the advanced decline ratio. On an update to have this go down, a little bit of a concern there. But when we look at our smart money indicators, looking pretty solid here, going up with accumulation distribution and above an advancing moving average. So this is positive. Even though the boom indicator isn't picking that up, we might be getting kind of far away from the moving average. And we saw an improvement where we were looking more negative after Monday with the shake and money flow. We're actually turning back positive. So this is smart money indicator number 2 that's now back to positive and turning back up and looking more positive with the Chaikin oscillator as well. And we did see an improvement with the vortex. The green line's on top, so it's positive, but it was declining. Now it's starting to go back up. Not much of a change here with the cumulative measurement of price for the S&P. Just kind of actually a bit of a decline there, and a little bit of a tick up after declining based on volume, and seeing a bit of improvement when we compare the S&P to the NYSE advanced decline line here, but not much of a divergence now. And on the broader market, though, we saw the cumulative advanced decline line for the NYSE. It's showing some improvement, but we're not really moving all that much with our regular NYSE advanced decline line or this other one. We're coming down a little bit, but we're still above the moving average. And when we break it out based on common stock, not really much of a change based on price or volume there. We're still above zero with the broad market measure of a 5-period moving average of the highs and lows. So broader term, that is still hanging in there positive. Saw a bit of an improvement with the advanced decline line studies coming slightly back above the moving average with the NYSE common stock, flat with the S&P on an up day. That's a bit of a negative divergence there. A little bit of an improvement with the mid caps going up, but still below the moving average with the small caps. And this is another thing. The 20-period moving average study of those stocks inside the S&P, an up day, and this continues to decline. And we're also below 70 and continuing to decline here. We're also flat with the 50 period moving average study and below 50, so that's negative. Also continuing to decline with the 100 period moving average study and the 200. So that's why I'm seeing the weakness is still starting to build, even though we had an up day with the S&P. And we were above average with volume, even though it dropped off here. And we're still above the 50 period moving average. But we declined a little bit with the 20, 50, and we were flat to slightly higher with the 200 period moving average study on the S&P. But in the short term, you see the Stochk RSI, it's still going down, but not giving us any kind of an extreme reading. And a little bit above the midpoint with the Williams percent R, and below the midpoint with the CCI 14, above the midpoint with the CCI 20. So there's no real uniformity to what we're seeing in the short term right now. And still nothing all that great with the stochastics in the short term. Intermediate term, we're still declining, trying to turn up, but negative since we're below the moving average with the long term. And slightly positive again with the force index. And we're below the green line and the blue line here with our short-term trend evaluation. And the lines are starting to roll over. We need to get back above this to turn more positive. But we're still above the simple and exponential moving averages based on 20 periods. So that's holding up for the short term. And we're back above the midpoint with our standard deviations chart. So that's showing an improvement. The balance of power is still looking pretty solid, though. It's continuing to go up and is above zero. The go, no go is more to a neutral positive now. The dark blue is positive, the lighter blue is more neutral. And here we're back above the midpoint with our highest high value chart. But we're still declining with the TTM squeeze, the darker blue, and we're continuing to go down. Ease of movement, pretty much flat, but still positive, where the Arun is just, it's still on vacation there. It's flat, but positive. And we're just barely, barely, barely negative here with the McClellan oscillator for the S&P. We slightly dropped below zero. So we're starting to roll over based on price. We're continuing to decline here based on volume. Now, after turning slightly negative after Monday with the NYSE McClellan oscillator, we've crossed back over positive again. So we're kind of flat right now with the summation index based on price and volume. And we're seeing a little bit of an improvement here at the Swenlin trading oscillator, at least leveling out based on price and volume, but overall they have been declining. Momentum is still positive, but weakening. We're rolling over with the PMO, rolling over based on price and volume, but all are still above their moving averages. A little bit of a tick up, but we're still coming down for the most part with the PMOs that are rising. The buy signals are still declining. We're still slightly going up with the PMOs that are above zero. We've gone from negative to neutral with the Elders impulse system for the S&P. We're still negative with the parabolic SAR. 2 days now with the dot over top. And this is the slope oscillator where we're turning down and starting to cross below the moving average, even though they're both pretty much flat, but they're above this green line here. That's why it's extreme positive. Rolling over, but still positive with the MACD. So we're seeing some weakness in the short and intermediate term with the oscillators. We're still looking positive with the long-term oscillators. Copy curve rolling over, but still positive. A little bit of an improvement here with the Sean trend meter. Money flow, pretty much flat, but still above 50. A little bit of an improvement with the ultimate oscillator, also above 50. Ticking back up slightly and above the moving average with on-balance volume. This is the mass index where it's still continuing to drop. At some point, I'll stop showing this because it'll not become relevant anymore. But for right now, since the market's chopping sideways and figuring out doesn't want to break to the upside or break to the downside, I'm keeping this chart in the video. But we're still working off of that Pring bottom fissure that was generated back in January. It's rolling over a little bit here, but that still is a buy signal. And we're back above 50 with the RSI 14 and the RSI 9. So that's showing more solid momentum in the short and intermediate term. The condition of the intermediate term trend, we're kind of right in between the blue line and the red line, and they're starting to go flat right now. But we're still above the simple and exponential moving averages. So the intermediate term trend continues to be positive. And we look at the spaghetti mess here with all these different moving averages. We're above all of them right now. That's why we say we're positive. And we're still declining, even though we bounced up a little bit with the bullish percent index for the S&P, a little bit of a tick up, but declining with the NYSE bullish percent index, and also a little bit of a tick up with the NASDAQ 100 BPI here. This is more positive, but you would expect with a nice up day for this to show more improvement. And still dealing with the this indicator here. It's a 20 period moving average of the open, high, low, close. We were able to get back above the mini rainbow. The lines are still going up. If we can stay above this, that would keep things more positive. This is longer term where we're hitting this overhead resistance right now. And we're seeing kind of a mixed picture here. The Heikin Ashi back to looking more like a doji after it had turned negative on Monday. We're negative but pointing up with the Kegi chart, or we're still positive with the Renko chart and the three-line break chart. So a mixed picture there. Long term, still holding up okay with our 150 and 200 period moving averages. So we're negative in the short term with the mid caps, but all of the other indexes that we follow have switched back to positive. And bonds are still positive in the short term based on price, negative in the intermediate and long term. And kind of a mix. Some of the defensive areas that did well on Monday, those saw some weakness on Tuesday with utilities, healthcare, and staples performing the worst. Energy had a pretty good day there, where we saw growth areas like tech, discretionary, and communication. Those were some of the stronger areas, and that's what helped the market to go higher. And saw some red right after the market opened with a MACD crossover with the BPI. Now, I'm not seeing that. We must have repaired that a little bit. We're not seeing the moving average crossing over, at least yet, where the industrial sector had a MACD crossover bearish there. The S&P was above 6,000. NASDAQ got above 19.4, then 19.5, 19.6. Energy had a BPI cross back above 50, where utilities were showing a bearish MACD crossover. So a lot of technical changes happening at the sector level. Not much of a change here when we compare the weighted versus equal weighted version of the S&P. And the Dow's still above its 50-day moving average, and it was up 0.3%, but not really breaking out. We're still neutral with the Elder's Impulse system with the diamonds. We're getting back above the 50-day moving average with the NASDAQ and the NASDAQ 100. So that's showing some improvement. And we've gone from negative back to positive with the Qs when looking at the Elder's Impulse system. Momentum is still pretty much flat to slightly negative for the NASDAQ 100. Small caps bouncing back up a little bit, but still not even close to their 50-day moving average. Also, still under the 50-day moving average with the Russell 2000 small caps. And gone from negative back over to neutral with the small caps with the Elder's Impulse system. Getting a little bit above this pivot point with the mid caps, but still below its 50-day moving average. And still negative with the Elder's Impulse system for the mid caps. We did get back above the 50-day moving average with the bank ETF. That was lost after Monday. Financial sector down 0.25%, but still above its 50-day moving average. The Wilshire, which was right at its 50-day moving average, was able to climb up above, and that's looking a little bit better there. And we're seeing an improvement with the total U.S. stock ETF. The FANG index was up 1.5%, still looking pretty solid, and that's still where the strength is coming from. So with Google being down, if that carries over into the open, that could have more of an impact on Wednesday's action. We're still holding up with this longer term trend line here. And if we really start to go up, we're wondering if that shorter term trend line will continue to provide overhead resistance. So Apple was up over 2%, but still below its 50-day moving average. Amazon setting an all-time high. Google, which is down after hours, it was up 2.56%, setting an all-time high there. Microsoft, still below its 200-day moving average, was up 0.35%. Meta, doing well, up 0.96%. Nvidia, up 1.71%, but still below its 200-day moving average. Tesla was up 2.22%, still under its 50-day moving average. Netflix was up 1.63%, setting a new all-time high there. And seeing a real drop off here when we compare US to world stocks on a short term basis, and we're leveling off with the longer term correlation. Oil still in the lower 70s, even though it declined a little bit here on Tuesday. The dollar is still in an uptrend overall. And we did decline with the 10-year yield. We're still above the 50-day moving average here. And this is the intraday chart that I've been watching, where we started a lot higher and then we came down with interest rates, but we're still above this 4.5% level with the 10-year yield. So seeing a little bit of an improvement here based on price for the 7 to 10-year bond ETF. We're watching the 10-year yield in Japan. If this continues to go up, that may cause some problems. And then seeing a little bit of an improvement with the Qs to S&P with our growth to value ratios, a little bit of a tick up with discretionary to the S&P, and a little bit of an improvement, but still below a declining moving average when we compare large cap growth to value. And so the large caps still under a declining moving average, mid caps showing some strength there, and continuing strength here with the small cap growth to value. So what's our outlook for Wednesday? We're still positive as measured by moving averages. And you can see there are some improvements, but there's also some weakness that we're seeing at the same time, and we're not trending. And that's kind of been the story lately. We're going to get the MBA Mortgage Applications Index. We get that every week. The ADP employment change, so more employment data will be coming out, and then the trade balance as well. And then we're going to get the final reading of the S&P Global Services PMI. And then the big one's going to be ISM Services, and that's probably what the market's going to react to. And then all the geopolitical things going on with the tariffs and things being kind of at the forefront. Then on Thursday, we'll get initial jobless claims as well as productivity and unit labor costs. And then the big report's going to come out on Friday concerning employment. Here's a look at the economic calendar. Seasonality neutral to negative with the Dow for February 5th, where we're just flat out negative for the S&P and NASDAQ. And first half of February tends to perform fairly well, but it's the second half where we start to see some weakness. And here's a newer chart here. February isn't a fan of post-election years. It's the worst performing month after an election year. So that might be why the market's running into some difficulties right now. And when you look at this other chart, the first half of February tends to do okay, but it's the second half that tends to underperform. And then February, again, this is another chart. It's the worst month in a post-election year. So there could be some weakness. And then small caps just are not living up to what they seasonally have done in the past. So we're still declining with the Swenlin trading oscillator, showing a little bit of improvement there, leveling off, but overall it has been declining lately. The parabolic SAR, and the reason why this is yellow is I don't treat it as a primary indicator. It's important, but it's kind of between a primary and secondary indicator. Where the gold, those are primary indicators. And one of them is the parabolic SAR, which is negative. And now we're going down with the 5-day equity put call ratio. Our moving average studies are weakening, and some of them are starting to turn negative with the 50, 100. We're still positive with the 200, and we're declining, but still looking okay with the 20. The mass index reversal, we're wondering, is that going to mean something? And we're still pretty much negative with the momentum for the NASDAQ 100. Well, these are a little bit out of order. Seeing some improvement with our smart money indicators, but are we extreme with accumulation distribution? Chaikin money flows back to looking more positive. The Chaikin oscillators also starting to turn back up and improving. The growth to value, discretionary to staples ratios, they're still holding up fairly well for right now. And on the 10-day chart of the equity put call ratio, that's going down, which is positive. The advanced decline lines are showing some improvement, but also showing some weakness as well. The ease of movement is looking positive, and we're getting a mixed picture here with the McClellan oscillator. We're just barely negative for the S&P. We're coming back to positive with the NYSE McClellan oscillators, and we're declining based on volume for the S&P, and we're in the process of turning more negative. So again, a mixed picture coming out right now. We're weakening with the momentum, but still positive with the S&P momentum oscillators. And we're showing a little bit of improvement, but we're still negative here. We've been going down with the bullish percent indexes. And the vortex is improving. So that's another primary indicator that's looking a little better. The money flow and ultimate oscillator are positive, and the financial sector is positive. So our conclusion, we're positive with some improvement, but at the same time, we're also seeing some weakness, and we're not trending right now. In the short term, same thing. Positive, not trending, some improvement, some weakness, and that's the same thing for the intermediate term. But we continue to be positive in the long term. Thank you. I hope you found this helpful. It's a little confusing right now. Have a really good day, and I will talk to you in the next video.